Hi everyone, welcome to my sweet luck. I'm Michael here. The essays of Warren Buffett, summary chapter 9 Tax Matters. Let's get started. A. Distribution of the corporate tax burden. I say this knowing that over the years there has been a lot of fuzzy and often partisan commentary about who really pays corporate taxes, businesses or their customers. The argument, of course, has usually turned around tax increases, not decreases. Those people resisting increases in corporate rates, frequently argue that corporations in reality pay none of the taxes levied on them, but instead act as a sort of economic pipeline passing all taxes through to consumers. Our conclusion is that Our conclusion is that in some cases the benefits of lower corporate taxes fall exclusively or almost exclusively upon the corporation and its shareholders, and that in other cases the benefits are entirely or almost entirely passed through to the customer. What determines the outcome is the strength of the corporation's business franchise and whether the profitability of the franchise is regulated. Almost all of our equity investments are owned by our insurance companies, and in that case, the exclusion is 59.5%. That still means a dollar of dividends is considerably more valuable to us than a dollar of ordinary income, but not to the degree often assumed. B. Taxation and investment philosophy. Berkshire is a substantial payer of federal income taxes. Charlie and I have absolutely no complaint about these taxes. We know we work in a market based economy that rewards our efforts far more bountifully than it does the efforts of others whose output is of equal or greater benefit to society. Taxation should and does partially redress this inequity, but we still remain extraordinarily well treated. There's a powerful financial reason behind Berkshire's preference to acquire 100% of a business rather than a small fraction, and that has to do with taxes. The tax code makes Berkshire's owning 80% or more of a business far more profitable for us proportionately than our owning a smaller share. When a company we own all of earns $1 million after tax, the entire amount inures to our benefits. If the $1 million is upstream to Berkshire, we owe no tax on the dividend. And if the earnings are retained and we were to sell the subsidiary, not likely at Berkshire, for $1 million more than we paid for it, we would owe no capital gains tax. That's because our tax cost upon sale would include both what we paid for the business and all earnings it subsequently retained. When we own 10% stake in a public market business earning $10 million after tax, our $1 million share of the earnings is subject to additional state and federal taxes of 1. About $140,000 if it is distributed to us. Our tax rate on most dividends is 14%. Or number 2, no less than $350,000 if the $1 million is retained and subsequently captured by us in the form of a capital gain, on which our tax rate is usually about 35%, though it sometimes approaches 40%. We may defer paying the $350,000 by not immediately realizing our gain, but eventually we must pay the tax. In effect, the government is our partner twice when we own part of a business through a stock investment, but only once when we own at least 80%. Thanks a lot, everyone. This chapter made it clear to me on why they prefer to buy 100% of a business than compared to in the businesses in the public market. So I learned a lot. A fantastic book, I would say that. And I can't wait for the closure or the conclusion of this book and see all the next last final chapter of this of the essays of Warren Buffett. Thanks a lot. I wish you my sweet luck.